Hey, it's Eric with Waterstone Mortgage, and okay, buckle up. This is your crash course into construction to permanent financing, or CP financing as we call it. So first off, what is it? What is a construction to perm loan? The way I like to explain it is that it's basically one loan comprised of two parts. There's a construction period and there's a permanent period. So think of it like this. If I'm giving you a mortgage loan on a standard transaction, you're borrowing money to buy a house that's already built. And I'm going to approve you like we would. We'll order an appraisal. We'll clear all the conditions and underwriting. And ultimately, we're going to close on that transaction. And when we close on that transaction, you get your keys and you move into your new house. With a construction to perm loan, the purpose of you borrowing the money is to actually build the house on that lot. The house is not yet built already, and the builder is not building the home with their money. Therefore, you need to borrow money, just like you need to borrow money if a home is not built already. But now you're borrowing money to actually construct the home. The beauty of a construction to perm loan is that you don't even need to own the lot. So let's say that's the case. You can purchase the land with the financing that we're giving you for this CP loan, and you can also combine the build cost. It's kind of the point of the loan. Let's say the lot cost $100,000 and the build cost was $400,000. In your mind, you would think of that like a $500,000 purchase price. Now, what if you own the land already? Even better. Think of that as like money that you've already put down. That's equity. So in a case where you own the land already, the loan that we would be giving you is to simply cover then the cost of the building. So in either scenario, if you own the land or do not, a strong competitive edge to our CP loan program here at Waterstone Mortgage Corporation is that we can lend up to a 95% loan to value, which equates to a 5% down payment. Most of our competitors in this space want a 20% down payment. You'll find a handful that will require 10% down, but most we still see are 20% minimum down payment. So that gives us a huge competitive advantage. Another competitive advantage to our CP loan program is our extended rate lock. We lock your interest rate on the permanent product, which doesn't even begin until your home is completed. So that's well down the road. But we lock it in today. And what we do is we set a rate cap. We say your rate cannot be any higher than a certain amount. But if rates are lower, when construction is complete, we float you down to market. So I always like to say we protect you if interest rates are rising, because if interest rates keep going up and up and up, we'll eventually reach a cap that we've guaranteed that your interest rate cannot be any higher. But if interest rates, let's say they stay flat during construction, or even if they go down during construction, we are truly going to float you down to whatever the market rate is at that time. So now let's dive a little bit deeper into what actually happens after we close on a CP loan, because it's a lot different than what happens when you close on a house that's already built. So with a construction to perm loan, as I said before, we're giving money from your loan to the builder to construct the house. But we don't just hand over all of that money to the builder, because therefore you would not be protected, nor would we. Instead, we disperse the money to a builder during the construction in the form of draws. And during construction, you are going to pay interest on the draws that we provide to the builder. Now, with a VA construction to perm loan, you're not allowed to pay interest during construction. We just have to simply collect the interest up front that we think will accrue. It works the same way, with the point being is that we don't just hand over all the money to the builder. It gets done in stages, which are called draws, and there's interest that is paid based on how many draws we give a builder. Now, ultimately, the builder is going to request a final draw, which means your home is completed. And a lot of times that's when people think that, oh man, I have to close again. Well, that's not the case with us. Our program is a true one-time close construction to perm loan. So at the end, you're not closing. We're simply modifying a construction loan to a permanent product. Sometimes you may have to requalify if we go past a certain time, but it's not a second closing. Because it's not a second closing, there's not a second set of closing costs. It's just simply a modification to a permanent loan. And when that happens, that's when your normal principal and interest payments, let's say on the 30-year fixed rate terms, begin. So if you're looking to build a semi-custom or custom build home, if you own land already, or if you don't and you're out searching for land, the CP loan program just might be the right option for you. I've been a lender for nearly 20 years now, and this program is something that I've done every single year. So it's a niche program and it's my area of expertise, and I would love to talk to you more about it and guide you through this process if you feel like this could be an option for you. If so, don't hesitate to call me today.